Well, I'm sure none of you know me. My name's Rick Lindsay. I'm president of Prime Insurance Company. Been in the insurance business for 32 years. Started out writing balloons in 1986 under the Worldwide Outfitter and Guide Association, which was the first risk purchasing group formed under the federal law passed by Congress in 1986 when there was an insurance crisis. And rafting guides, helicopter ski guides, tough classes of business could not get coverage anywhere. And we provided that coverage for 10 years with Homestead Insurance Company nationwide. And they got into financial trouble, as many insurance companies do. And that's when I took over Prime in 1996. And we own Evolution Insurance Brokers, which is a nationwide surplus lines broker. We manage all of our claims in-house with our own legal staff. We have 7 attorneys on staff. We've closed over 20,000 claims nationwide. And we also issue Lloyd's of London paper nationwide, including balloons. So I'm the head underwriter appointed by Lloyd's and claims manager appointed by Lloyd's. So we've written coverage for balloons since 1986. 7 kids and 1 wife. And I'm from Utah. Happy to be here. Thanks.
All right. Well, I want to thank all the panelists for being here today. And so now what we're going to do, like I said, is we're going to come out to you and ask you guys to ask the questions if you want to direct it towards one of the agents or all. It's kind of up to you how you want to do it. So.
My biggest concern in any insurance, be it property casualty, whatever, is liability limits. So I'm kind of curious where you're at on your current liability limits, both aggregate and passenger, kind of where you see the market as far as that goes.
We can issue any limit you want. The aircraft world is unique in the 100,000 per person limit. Most coverages we issue to other businesses, whether it's skating rinks or tow truck operators or physicians, all hard to place classes, none of them have 100,000 per seat or per patient limit. Or so, we see that as an advantage in this class because it does keep the limits low. Obviously, whether you carry a million limit or 100,000, you can always be sued for more than the limit you carry. And traditionally, the attorneys do sue you for more to try and create that leverage against the insurance company, which is known as bad faith. And if an insurance company is put in a bad faith situation, you have no limit on your policy, and the insurance company is responsible to pay whatever award is delivered by the jury. And that's why insurance companies settle so many claims, because the attorneys know how to set up that bad faith situation, puts the insurance companies in a pickle, and that's why 98% of all claims are settled. We take pride, as I mentioned earlier, we close 20,000 claims nationwide. Regardless of what the limit is, we work with our insureds to get the best settlement possible. We had 440 nursing home claims in Florida. You may be aware that nursing homes in Florida were a particular problem because of a large judgment that was awarded there. Nobody would insure nursing homes except us. We had 440 lawsuits. Our average settlement was under $20,000. And most insurance companies' average settlement is over $1 million in Florida on nursing homes. But as an insurance company, we can't accomplish excellent claims performance unless we have a good insured partner. And in many cases, as an insurance company, we don't have a good partner. We've got somebody who thinks, just pay the claim. That's what I buy insurance for. And that's short-sighted. You got to take a long view on insurance and realize that if you settle a claim that's not, that doesn't have any merit, you're going to get more claims. And so we've taken more jury trials to trial than any other recreational insurer. We have Supreme Court rulings in 8 states
relatively new on the scene, and I just wonder your policy form versus IMC or chance. I know there's two different forms. Can you explain the different form that you have that you don't see from the other two companies? The per occurrence form as opposed to the claims made?
Sure. Per occurrence is an inaccurate term. It's called an occurrence form policy or a claims made policy. I've been writing rafting guides and Grand Canyon since 1986, which Tudor also does. And the claims made policy form in recreational businesses, we've never had a claim until we've denied under a claims made form. So we actually offer both policies. We work with the New Mexico Aon broker on the Balloon Fest to draft the policy so they would accept it. So we offer both policy forms. The occurrence policy form is more expensive. Our focus is on partnership. So if you have a claim, hard landing, somebody trips in the pasture, walking away from the balloon, you should have an insurance partner that you feel comfortable reporting that to and working that claim through with. We take what we call the Disneyland approach. All of our policies include excess medical, whether it's the claims made or the occurrence form, includes excess medical with no deductible. So that if you have somebody injured, whether it's hard landing, they hurt their knee, twist their ankle, we want you to be proactive, reach out to them, take them to the hospital, do what a responsible business owner would do so that your client feels like you're caring about their situation. We, under our policy, pay the out-of-pocket medicals. I mean, in the rafting business, we have deaths. Helicopter skiing, we have deaths. We fly the family out. Again, we pay all of those expenses under the excess medical. That creates goodwill between you and your customer. And in most cases, we get rid of 80% of the lawsuits by paying that excess medical. It doesn't cost you a penny. Traditionally what happens with most insurance companies is they get rid of medical payments under recreational cases because they don't want to deal with the small injuries. And what happens, like Beth said, is they don't think they're suing you. They think they're suing the insurance company. And so, they're aggressive. You have the ability to intercept that and take an active role in that. Most of my insurers over 30 years have told me, well, my insurance company said I shouldn't do that. I shouldn't talk to them. I shouldn't offer to pay their medical bills. And we don't say you should offer to pay their medical bills. We say stay in touch with them. Contact them. If they're injured, go to the hospital. In death situations, we say you go to the funeral. They want to know that you're there. If you don't go to the hospital, you don't go to the funeral, within a short period of time, they're going to start thinking, well, why didn't Bob ever call me? Why didn't he give a crap? And so we take a real proactive approach, and again, a contrarian approach by providing you the excess medical payments with no deductible or self-insured retention. So claims made, occurrence, whatever you feel comfortable. Most physicians, most professional liability people have claims made policies. And they have tails on their exposure longer than you guys do. I mean, when somebody leaves your balloon or leaves your trip or your ride or your event that you're holding, you know whether there's been an accident or not, don't you?
In all due respect, you do not. I'm sorry. I have had claims that have come up 18 months later. And I would
Tell
ask...
me what those were.
I would ask you to maybe... You're confusing me.
Give me an example.
Can you... I'll give you an example.
Oh, now the question was about the difference between claims made and...
In all due respect, can you focus on aviation insurance? I'm kind of confused with whitewater rafting and the other insurance that you're providing.
Whether it's aviation or
It's a town hall meeting, not a debate right now, so let's go ahead and get another question.
I was just also wondering if you could explain retroactive date and a tail. I think that those terminology gets lost for a lot of people that aren't used to dealing with insurance policies that we haven't seen in the balloon sector for quite a while.
Okay, so basically a retroactive date, if you were at an occurrence policy or a claim made policy and you had a claim 3 years ago that you were worried worried about coverage or not, I can give you a retroactive date going backwards to pick up those prior years, and we rate it year by year. A tail coverage is when you have a claims-made policy that's expiring, that you're not gonna renew with that carrier. They have to give you the option to buy a tail, which is 1, 2, or 3 years, which would allow you to report claims that had occurred, but you don't know about yet. Now, if it occurred, if you had a hard landing and somebody has injured their knee and you report that, under our claims-made policy, that's covered. So, you know, people want to put claims-made and occurrence in 2 buckets. Our policies are all manuscript and designed to perform for you, the insured, with a good insurance partner as an insurance company. I've been in this business 30 years, and I don't feel like I have a good insurance partner. I'm with State Farm. I know the minute I had a claim, they cancel me. You know, that's how insurance companies work. So you need a good partner as an insured. I don't care whether it's your homeowners, your balloon business, river runner, whatever. You need a good insurance partner. All due respect to these guys up here, they're great agents. They've been doing it a long time. They know the business. But as an insurance agent, you're only as strong as your company, and the company's only as strong as its claims.